Welcome, students and professionals, to this educational explainer on the new compliance landscape under the Income Tax Act 2025. I'm absolutely thrilled to guide you through this material today. Look, if you're a chartered accountant, a tax practitioner, or a business owner managing your own books, you already know that keeping up with statutory changes is literally half the battle. So today, we are zeroing in on a very specific, highly critical area of the new Act, Chapter 19 FX, which covers sections 427 through 430. Let's dive right in and decode exactly how the new law approaches the levy of fees in certain cases.
Right, let's start with a scenario we have all faced. What actually happens if you miss your statement filing deadline under the new Income Tax Act 2025? It's that highly relatable compliance anxiety every single tax professional and business owner experiences at least once, right? Under the old 1961 Act, late fees were just a known hurdle, but the 2025 Act has really streamlined how these defaults are handled. It brings a lot of structural clarity and reduces interpretational disputes. So we really need to understand exactly what triggers these fees now, and more importantly, how they are capped.
Here's our roadmap for today's session. 1. Introduction to Chapter 19 F. 2. Analyzing the legal provision. 3. A practical taxation example. 4. Compliance and common issues. And finally, 5. Key takeaway summary.
Okay, starting off with Section 1, Introduction to Chapter 19-F.
So what exactly is Chapter 19F? Well, it's the specific legal framework within the Income Tax Act 2025 that governs the levy of fees for defaults in certain compliance cases. Spanning sections 427 to 430, the overarching objective of this chapter isn't just to penalize people. It's genuinely there to enforce timely compliance and enhance voluntary adherence to the law. As we transition from the old regime, this chapter ensures that the consequences for late filings, whether that's for statements or returns, are clearly defined and structurally straightforward.
Moving right along to Section 2, Analyzing the legal provision. Let's dissect the actual letter of the law.
The absolute cornerstone of our discussion today is Section 427. This section deals specifically with the levy of a fee for defaults in furnishing statements within the time prescribed under Section 397(3)(b). So, the absolutely crucial takeaway here is that this section is triggered the very moment a person fails to deliver or cause to be delivered a mandatory statement on time. It is a strict, clock-driven provision. You miss the deadline, the clock starts.
Now, for the veteran practitioners tuning in, you'll definitely recognize that the spirit of the old 1961 Act carries over here. The 2025 Act doesn't just invent a completely alien tax concept out of nowhere. Rather, it modernizes the framework. While Section 427 handles the delayed furnishing of statements, its sibling provision, Section 428, prescribes the fee for the delayed filing of returns. The whole intent behind replacing the old Act was to simplify statutory language and align the drafting style with modern standards. The core principles remain, but the application, much cleaner. Let's break down the exact statutory elements of Section 427. First, as we just noted, it triggers upon failure to deliver statements under Section 397(3)(b). Second, it imposes a strict, mandatory fee of 200 rupees for every single day the failure continues. And trust me, the taxman's clock does not take weekends off. However, the law does have a built-in proportionality. The total fee amount is capped. Subsection 2 of Section 427 explicitly states that the maximum fee cannot exceed the amount of tax deductible or collectible. This cap is a massive, vital safeguard for taxpayers.
Let's move into Section 3, a practical taxation example. It's time to see how this theory plays out in reality.
Before we run any calculations, I really want to emphasize this number, 200 rupees. This is the exact daily quantum of the penalty. For all your accounting prep, just remember that the clock starts ticking the very day after the deadline, tacking on 200 rupees every 24 hours until the default is fully cured. Let's see exactly how that maximum cap protects a taxpayer when a delay gets completely out of hand. We'll walk through a mock calculation together. Take a 10-day delay. At $200 a day, that gives us a calculated fee of $2,000. Since the tax-deductible amount is $5,000, the cap isn't reached, so the final fee is just $2,000. Simple enough. But look what happens with a 30-day delay. That yields a raw fee of $6,000. Because our tax-deductible amount is only $5,000, the statutory cap kicks in, saving the day and limiting the final fee to $5,000. The exact same logic applies to a 50-day delay. Even though the raw calculation shoots up to $10,000, the maximum fee payable remains firmly locked at $5,000.
All right, bringing us to Section 4, Compliance and Common Issues. Let's look at the actual mechanics. The law mandates a very specific, step-by-step procedural flow for adjusting these fees. According to the text of the Act, first, you compute the fee under Section 427. Next, you absolutely must adjust this computed amount against any amounts already paid under Section 397(3), 398, or earlier payments under 427, along with any other tax or interest paid. Only after making these precise statutory adjustments do you arrive at the final net amount payable by, or the refund due to, the deductor or collector. After all that, the system generates an intimation specifying this final amount.
CA students and professionals, please pay close attention here, because these are the common pitfalls that lead to very costly administrative errors. First up, miscalculating or completely ignoring that maximum statutory cap we just mapped out. Another frequent nightmare is failing to properly adjust the Section 427 fee against prior payments before finalizing refund claims. Also, do not confuse your statements with your returns. Remember, Section 428 handles delayed return filings separately. Finally, chronic noncompliance isn't just about late fees. As the guidance clearly notes, it can escalate to severe penal proceedings under Sections 461 and 465 2G. You definitely want to avoid that.
Which brings us to our final section, Key Takeaways Summary.
Let's do a rapid-fire summary to lock this all in. Section 427 strictly mandates a $200 daily fee for delayed statements. Crucially, this total late fee is legally capped at the total tax-deductible or collectible amount. Section 428 runs parallel to this, handling the fees for delayed return filings. Always ensure strict adjustments are made against previously paid amounts before you finalize any net payable or refund due. And never forget that chronic noncompliance opens the door to further, much harsher penal actions. Understanding these guardrails ensures a smooth practice and thoroughly protects your clients.
And that brings us to the end of our explainer on Sections 427 to 430 of the new Income Tax Act 2025. I really hope this structured breakdown has made these provisions crystal clear for your daily practice. As we transition fully into this new regime, it leaves us with an interesting thought. Will this streamlined, automated capping genuinely reduce litigation, or are we simply going to find brand new complexities in modern compliance? Let me know what you think. Thank you so much for watching. Please like, subscribe, and share. This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.